With all the medical advances and life growth expectancy, you don't want to outlive your money. So make sure you have a plan on when you stop having active cash flow from a job or your business.
Hi, everyone. This is Katana Abbott, and welcome to Smart Women Talk. Today, we're talking about something that affects every woman, regardless of her age, income, or stage in life. And that is, how do we make smart financial decisions when the economy feels so uncertain? Joining me today is Sweta Singh. She is a portfolio manager and the co-founder of City Different Investments. Sweta has spent more than 2 decades helping investors navigate changing markets, interest rates, inflation, and economic uncertainty. She believes the bond market may be the most honest signal we have about where the economy is headed, and today she's going to help us make sense of what matters most. Welcome, Sweta. I am so excited to have you here on Smart Women Talk.
Thank you for having me, Katana.
Absolutely. So why don't you tell us just a little bit about how you came about getting into the investment industry and also how you ended up working with bonds?
So first of all, again, thank you for having me. I'd say that as a child, how some people know what they want to do. It was absolutely not the case with me. My greatest love has always been food. However, for me, I fell upon finance actually through school. I went to school for public policy and happened to get a fellowship to work for New York State as an issuer of debt. And I got involved in this world of public finance, or the bond universe, as on the buy side we'd like to call it.
Oh, so that actually happened, with your first job?
That was my first job. I was involved with debt issuance for New York Thruway, the Tappan Zee Bridge, refinancing. I could go on about the difference between East Coast infrastructure, West Coast infrastructure, but to me, so that was New York, Albany, and home for me is Boston. So I was looking for jobs in Boston after 2 years when my fellowship was up, and I ended up in my first buy-side firm, if you will, called Wellington Management in Boston. And so began my 2 decades journey in finance.
So what you were just talking about, though, for listeners, is what they call municipal bonds, correct? And they're
correct.
And they actually have revenue coming in, and that's from the taxes that we pay. They get funded through the revenue comes from taxes. So taxes. So we'll just keep that in mind, because we're going to talk a little bit, not a lot, okay? Not a lot, ladies, but just a little tiny bit about what bonds are. And that's just one kind of bond.
Correct.
Okay, good. I know that women hear so much conflicting information about the economy. They hear things about interest rates and the stock market is too high right now and all these things. What's the biggest misconception that you think that people might have right now?
I think this is an oldie but a goodie, that you can time the market. As both institutionally and for retail, which is mom and pop, as we go about investing in our life, you cannot time the market. People have spent their entire lifetime trying to do this. To catch the top and the bottom is a Herculean task. And you have a lot of institutional money betting against you. So don't even attempt that. This is boring. This is as boring as brushing and flossing your teeth, doing the right thing that our parents taught us. When it comes to the investing world, what it translates into is stay invested, know your time horizon for what you're saving for. And it's probably people on your side of the pitch, Katana, that might do a better job than I will of explaining this principle of stay invested, know the time horizon for which you want to stay invested in, the purpose of your money, and then asset allocation. Simple, boring, driven by principles rather than cyclicality of markets.
And when we talk about asset allocation, we can think about a pie chart. And that pie chart has different pieces. And so part of that could be cash, part of that could be gold and silver, Part of that could be real estate. It can be stocks. It can be bonds, crypto even, because that's a newer one. And depending on how much risk someone's willing to take, how young or old they are. And again, you mentioned one other, time horizon. So those three things come into play.
Yes.
And so it's not just staying invested. And we do not want to time the market, but we want to stay invested in the market and work with our advisor to get the proper asset allocation for all of those things. So now let's talk about, you've lived through several of the market cycles yourself. So you've seen things like recessions. You've seen what's happened with Fed policy. And I've been watching a lot about the different Fed chairs and what they all did. And just global events like something that's going on right now with the Middle East. So what have those experiences taught you about accumulating for long-term wealth? What would you like to share?
I might revert back to the same answer of know your time horizon and your asset allocation. And like you were referring to, stay diversified. Think about if you were a gambling woman and went to Vegas, right? Putting all your chips in one basket versus diversifying it, unless you absolutely knew what you were doing. And then the luck gods and the odds have to stack up against you or stack towards you and in your favor. For most of us, really, whether we are in the market or just participants and investors, diversification is key. What I have seen that in moments of crisis or great dislocation, whether it was the GFC, which is the 2008 crisis, COVID, taper tantrum, the Ukraine war, right now in 2026, I call this a geopolitics special in terms of volatility, right? There is a ton of volatility, but it's clean, simple principles that you were alluding to in terms of you stay invested in the market, be allocated across different asset class. Then, what in industry speak, we call correlation of different asset class, stock and bond. Think about the traditional 60-40 portfolio, 60% in stock, 40% in bonds. In times of great volatility, you see the correlations come to, they don't no longer stay as uncorrelated asset. The correlation comes down to zero.
Okay, so you're using a term correlation. Okay, so let's just put it in very elementary terms. The idea they talk about with the 60-40 portfolio, what is correlation and what does it mean with the 60-40 portfolio? Why are those two things important?
Sure. So say if I have $100,000 to invest and I put $60,000 in stocks, I buy a S&P 500 index fund, no cost index fund, and 40% I put it in a bond portfolio or a bond fund. So my hope is that, hey, I have put it in two separate asset classes in times of volatility when stock market corrects itself, falls by 10, 15%. At least I have my bond portfolio that is uncorrelated by the losses in my equity account, and my stocks and my bonds will be the ballast of my account. And when stocks are falling, bonds will hold their value. Most times they do. But you have to be mindful that there are times when this correlation or the relationship between stock and bond going in opposite directions sometimes cater or collapse, and they both move in the same direction. Whether equity market melt up, going up, the bonds sometimes go up with it, or coming down.
That happened a few years ago. So a lot of
happens all the time.
But I mean, big time it happened where the bonds lost
22,
20%.
Yes.
If you had longer term bonds, people were like totally freaking out. I was getting the phone calls. I don't manage assets anymore, but I was getting phone calls from my clients asking what should they do.
Why am I losing money in
Yes.
Yeah.
Because you think of a bond as very safe, and if you hold it till it matures, you'll get your money back. But in between, there's volatility.
Correct.
So when something like that happens, though, what are people supposed to do?
If you can, you need to wait out that event. And depending on your conviction, and if you're working with both a financial advisor who in turn is working with an investment manager like myself, I'll give you a peek into how we at the trading desk, for example, think through these events. So if the market crashes, I'm a bond fixed income manager, so I'm going to use bond examples and scenarios, but you could substitute this for equities too, because there's some overarching similarity when it comes to risk taking. And truly, you're getting paid to take risk in the proper fashion when you sit in my seat. So when there is the sharp drop in prices, there are two things you could do. You can wait it out, do nothing, but remember that doing nothing is also an active decision. Most people think about doing nothing as a passive thing, but there are consequences associated with doing nothing. So for us as managers, that is a very active decision of, hey, don't want to catch falling knives, will not do anything. The second, and the more exciting piece for us, is if we have conviction in our theses, whatever it might be at that time. So let me give you an example to make it clear. Say I'm buying a bond, the price goes down. There's some event that the market caught on, is nervous about. Now, if I have done my bottom-up fundamental analysis, and I believe in management, and I believe in that story associated with that bond or that stock, for example, I see that as an opportunity to go in and buy some more at a lower basis. But let your manager do that, or let your advisor do that. But if you've hired the right professionals, that's probably what they're doing at that time, because really, then you're buying something at a discount. It's shopping in the Macy's basement at that time.
Yeah, okay. But for most people, if they're working with a financial advisor, they understand that their financial advisor more than likely is watching this. They're aware of that. But there are a lot of people that are investing for themselves. What I've found in reviewing the financial statements for many people right now, these are people with 401ks that are retired or near retirement, is almost every single one of them is 100% in stocks. And they've been like that for years. So they've done phenomenally. But now as they're nearing retirement, I'm scared to death for them because the market is, would you say you agree the market is very high right now?
In frothy, definitely.
Yeah. What would you suggest for people that are either in retirement or close to retirement and their portfolios are pretty much all equities or equity mutual funds? Because they also are going to have to pull income out. And if we have a major correction, that could just ruin their portfolio for the long term because they'll have to sell when the price is down. Should they have cash? Should they have some more? Should they sell some, take profits, and do some bonds? Like, how would you suggest they position that? Not for a specific person, but in general.
Yeah, that makes me nervous. Hearing that because the market is frothy, and especially on the equity side. And not that I'm a market timing specialist here, but I love this saying by John Kenneth Galbraith, which goes, the market can remain irrational for longer than you can remain solvent. And this is just a good financial practice to make sure you have, if you're thinking about your portfolio as a pie chart, that you have at least 1 year of expenses in something liquid. Money market funds are that proxy. But here's the tricky part with money market funds. They are tied very closely to the Fed's policy. And we can come to the Fed's policy in a little bit, but just make sure you have a portion or at least 1 year worth of expense, especially if you're entering retirement, where you got you and don't depend on the financial markets for that. Then I think it's good old rebalancing. if you have been the recipient of good fortune from the equity market, yay. Now let's protect that winning. Let's protect that corpus, if you will, whether it's your taxable piece, taxable accounts, however you're thinking. But let's diversify and use some kind of proxy for stock and bond. Usually people do 60-40, 70-30, depending on, now, thankfully, we all have a long retirement, depending on when you retire. And actually, this conference that you and I were, Donna, they were talking about how 85% is the largest growing segment demographically.
We're really living long.
We're really living long.
When Social Security first was started back in the 30s, the life expectancy for men was, I think, close to around 60. Just a little, I think it was actually 59. It was insane. And today it's over 80. And when here, the Social Securities didn't even start back then till 65. And still, it starts full retirement at 67. And we're living into our 80s, 90s. We even have a lot of centenarians, as we hear. So we have to generate income for ourselves. And that's the one thing that's nice about having some bonds in the portfolios. They can generate income, interest.
Yes. With all the medical advances and life growth expectancy, you don't want to outlive your money, as harsh as it sounds. So make sure you have a plan on when you stop having active cash flow from a job or your business. Your portfolio is throwing off enough income for you to live with dignity and for it to cover your expenses, and take the cream off from the stock market that you got over the years. Invest that in bonds. And now bonds, that is a big spectrum too. It can go from high yield. So for example, companies, Uber or any of these big growthy companies on the equity side, they issue bonds too, but they are high yield bonds. And this is a personal bias, I believe in taking those big risks in the equity market. To me, the bond market is my sleep at night money. I come from this philosophy called total return philosophy. This is what that means. Taking risk only when you're getting paid to take that risk. So in the bond market, there are two types of bond philosophy. One is income maximize, and either are good or bad, but it's so personal. You need to understand the kind of human you are and your risk appetite here. Also where you are in life and the amount of risk that you can take, which your advisor will walk you through. But if you don't have an advisor, understand this basic principle. They're income maximizers. These are bonds that give you really high degree of income. But guess what? There will be volatility or huge swings up and down in your portfolio. The other part is, and this is the part that I represent in the bond markets, total return. We strive to give you a stable, a durable dividend stream. Might not be the highest, might not be the lowest, but it will be stable. Nothing wrong with either, but understand what you're buying. Are you buying a total return fund or are you buying a high yield or income maximizing funds? They both are supposed to do two different things.
People don't realize when they see a very high interest rate or they'll say, wow, look at this fund here. It's paying out 10%. I remember my client calling me years ago about a General Motors bond that was, I think, 11 or 12% back during the Great Recession there. And I had to explain what was going on with that and what the risk was, and it got bailed out. And so it was okay, but there can be risk. So when someone is buying a stock, it makes sense. We're buying shares in the company, so we're an owner. But when they buy bonds, it's a different role. Can you talk about the role and whether we go by one company bond or a government bond versus a bond fund? What are we actually doing? Because you talked about Uber can issue bonds. What are they doing?
Yeah, that's a really interesting question. So on the stock side, right? Like when we buy a stock, I think it's the famous explanation by Warren Buffett. You are an owner of the company. Think of yourself as an owner of the company. You could buy a stock for $100 or you could buy a stock of $1,000,000. That's just a proportional share of representation or ownership of that company. Now think about the capital chain of that company, right? You have the owners, then you have the creditors, folks that you borrow money or the company or that lend money to, say Uber, for example, sticking with that example. So now as a debt holder of Uber, Uber is obligated to pay me an X percentage for borrowing money from me. As an investor, I am going to collect an X% of coupon and principal for lending money to Uber. Now, here are the pros and cons of being a stockholder or bondholder. Stockholder, trees go up to the sky in the scenario, as you can see right now in today's equity market. And that's called volatility. And we love volatility when things are working our way, right? Now, going down is also volatility. It's just that we don't appreciate that volatility. That's the stock market for you. On the bond side, your returns are capped at that X percentage. If you mentioned 9-10% for GM. Now, GM or Uber has to pay me, the creditor, before it pays you, the owner, right? So I'd come first in case of bankruptcy. My claims to their money comes before your claims to their money. So that's how the bondholders sit and the stockholders sit in the capital chain. Did that answer?
Yeah, no, that's a good explanation. So let's talk about the Federal Reserve a little bit, because we're all hearing about the Federal Reserve and Kevin Warsh now, who is our new chair, and we understand there's a Treasury Department. But can you tell us why the Fed and their decisions matter and what women need to pay attention to about their decisions?
And I just want to underline the power of the Federal Reserve, right? There's the monetary policy and the fiscal policy. The monetary policy is controlled by the Federal Reserve. Here's why the Federal Reserve matters. So the mandate of the Federal Reserve is twofold. One, to control inflation. And to be very specific, the Federal Reserve has a 2% mandate for inflation. Inflation, as measured by favorite measure, which is core PCE, core personal consumption expenditure, is as of April at 3.3%. And remember, its mandate is 2%. So full percentage and 1.3% higher than where it wants to be. This is why inflation matters. Inflation's enemy number one of fixed income markets, your dividend, your income, especially if you are living on fixed income. It matters because your cost is no longer fixed. Inflation is a boogeyman that you're fighting with on your fixed income. So inflation's public enemy number one. The Fed it's a policeman, if you will, of controlling inflation. Secondly, the second mandate for our Federal Reserve is full employment. Now, they did not put a number to employment. When we entered 2026, I was really nervous about employment. It was, hey, AI is coming in, AI is going to eat all the jobs, fresh college grads won't get jobs, employment, we will all be obsolete, we'll be replaced, AI. And this teaches you humility in this profession, not just big booms and busts, but the unpredictable nature of the markets that we live in. Flash forward from January to February 28th, you saw the whole tariff thing unraveling, where Justice Kavanaugh and the Supreme Court said, the tariffs are illegal. Administration, you need to refund $170 billion in tariffs. Now, you asked me, what does the Treasury do, and the function of the Treasury and how the Fed and the Treasury interplays. So that 170 billion that needs to be refunded from the tariffs is probably going to be refunded in the treasury market. And just a warning or PSA, here's where I'm going to get very geeky. This is where U.S. federal deficit starts mattering. We've been teetering between 30 trillion to 40 trillion in U.S. deficit, which is anywhere between 5 to 5.5% of U.S. GDP. Now, why does this matter? Your Social Security, your entitlement program, Medicare, Medicaid, a lot of it is, or all of it truly is funded by the U.S. government. And it's their ability to fund these programs while sitting on this giant deficit. It matters because the government's going to go and look for programs to cut so it can fund this. So the U.S. Treasury is going to issue treasuries to refund those tariff payments. Then March 1st or February 28th, Strait of Hormuz, Iran-Israel-US conflict comes. Now, what that did is it flipped the script for investors. No longer was employment a problem or tariff payment a problem even. I feel that the market right now has ADHD, right? We can only focus on one problem at a time because these are really big, enormous problems. Enter Strait of Hormuz, conflict, and now inflation. Energy prices have superseded. And you mentioned that you started in the market in 1987. This is very different than the 70s energy problem. Because at that time, U.S. was a net exporter of energy. And now we are energy self-sufficient. And we don't import. So Asia, for example, is really hurting from the Strait of Hormuz and not having enough gas. I think there are countries like Korea, Japan, and India that are rationing gas. But fortunately, not our problem for yet. We'll see maybe Europe will have some pain. Long-winded way of saying that the market really humbles you. I entered the year thinking employment is a problem, but now inflation and not employment. Employment's been okay. Employment has been rosy, actually. And AI hasn't really eaten jobs as we thought it would. Instead, what has happened is companies that have overhired in their expansionary phase are shedding jobs under the disguise of AI, but are using it to clean house. So for AI to be all that it is, will take a while, and it will probably not happen in a linear fashion. Very few times in life does life work in a linear fashion, be up, down, unforeseen consequences, new job titles that will be added. Remember when we thought bank tellers would become obsolete because it was tech and online banking, but there are all these new jobs that were added. Data teller, a ton of new jobs, new job titles that we aren't even aware of were created. And something similar like creative destruction, an economist called Richard Florida talks about this. So that could happen with new titles, unforeseen consequences. My long-winded way of saying, stay invested. Seldom does the market really behave like you expect it to behave. It really is a master that humbles all of us.
There's so much confusion out there. What should women really be looking at? What should we be really focused on right now in this time?
The answer is understanding your risk appetite, your time horizon, and your asset allocation mix, and trying to be a little hedging in terms of being uncorrelated in your selection of different asset classes, whether it's stock, bonds, to your point, commodities, gold, silver, if you are into crypto, whatever your risk appetite and time horizon is. The market, it will fluctuate a lot. It is a very volatile market. And it is my belief that the second half of 2026 will continue. Volatility will continue because you have the midterm elections. You have some really big IPOs coming out. So be prepared for a lot of volatility and just stick to your asset allocation model. Don't put all eggs in one basket. Be diversified, have exposure to bonds, have exposure to metal, and equity. And when the equity market gets really frothy, like it is right now, rebalance a little. Take some of your gains, put it in bonds, put it in commodities, and you can pick out any asset allocation model as a guidance now out there, and just make sure when you look at your funds or individual names that you stick to some kind of formula, and that is your investing discipline.
Yeah.
So to your point of market peaks, the market indicators, stick to your discipline. Be boring unless you are that super active stock picker, and that's where you want to dedicate your time to. I'd say just stay invested, because staying invested, there are several studies out there that show if you stay invested, you really do well in the long run. Then when you pull market timing, usually so many studies show it truly doesn't work.
Yeah. So I'd like to wrap things up right now. This has been wonderful, so educational. But I think the secret you're saying is work with an advisor.
Yes. If you can, absolutely work with an advisor. Maybe work with an advisor that can work with a manager and that will listen to you and customize it for you.
Sweta, it is so nice. So your company is City Different Investments. People might want to learn a little bit about you. Can you give them your website?
Sure. So we are called City Different Investment. We're named after the city that brought us together, Santa Fe, New Mexico. Beautiful city in New Mexico. The website is www.citydifferentinvestments.com. And you can find me there, send me an email. Happy to chat.
Thank you so much for being here.
I really enjoyed talking to you. Thank you, Katana.
During this important time. Thank you so much. All righty. Okay, and everyone, to learn more about Smart Women's Empowerment and how you can get involved with our programs that we offer periodically, just go to joinsmartwomen.com. We're so glad you're here. Until our next show, go out and live with more purpose, passion, and prosperity.